All right, in this lesson, we're going to be talking about notes payable and reviewing some of the things that we already know, and then go through the process of how we actually book a notes payable into our book. So let's get started here with notes payable. So just as a reminder, these are formal debt in which a note is signed for the repayment of any obligation due to the creditor. So we are owing money or something to a creditor, someone else, so we call them creditors. And so we do this in the form of a notes payable when it's formal. Usually it's written and there's signatures involved and there's some other aspects to it that are key that is more formal than just an accounts payable. Now, one key aspect of a notes payable is the interest portion of the notes, and that's what we're going to kind of focus on in here in this lesson. We're going to show you how we calculate that interest so that we can book the interest expense when it comes due at the end of the period or when we pay back that note to a creditor. Now, generally speaking, there are two types of notes payable, and really the difference in the notes payable that you need to know is how it's being paid back. How is the principal being paid back to the creditor? So the first type of notes payable that you might see, and actually we're going to be looking at the most here, is the lump sum version of the notes payable. We also have something called the annuity version of a notes payable. So we're going to focus most of our attention on the lump sum, but there could be instances in the future where you're going to need to know how the annuity works. So the lump sum, the way that the lump sum works is that in the notes payable, we paid the principal, the entire amount that we actually borrowed when the note matures. So if we borrow $1 million on a 5-year note, we will get that $1 million today, but we don't have to pay that principal back, the $1 million, until it matures in 5 years. So every year, we're just going to go ahead and get to keep that $1 million. And then in year 5, we'll have to pay that lump sum back. Now, interest does still accrue, and interest is often paid every 6 months in these contract type things, but we're not paying the principal back. Now, this is different from the annuity in that the annuity, the principal payment is made at regular intervals through the note term. So oftentimes you can think of an annuity as a car payment. So when you make a car payment, you're not only going to pay the interest, but you're also paying part of the principal, so that when you get to the end of your car payment, you don't have a lump sum. So if you borrowed $25,000 for a new car, you're not paying $25,000 at year 5 when you pay off the car. You're only paying, let's say $500. Why? Because you've been paying a portion of that principal the entire time, and you've now gotten down to where you only owe $500 at the end of its term. Not the case with a lump sum. So lump sum, you borrow now, but you pay that back at the very end. You do pay some interest throughout the time, but that's very minimal in comparison to that amount that you borrow. The annuity, we're going to take that loan and spread the payment over a period of time, and you're going to pay both the principal and the interest. Now, we are specifically talking about the lump sum, not the annuity. All right. So let me give you a timeline of the events in the life cycle of a notes payable. So there are basically 4 different events that occur that are related to a notes payable. So it says receivable, it's payable. Payable. All right. First, we're going to establish the note. So we're going to establish the note with a journal entry. The second thing we're going to do is we're going to accrue the interest on the note, because as we borrow that money, we're going to have to accrue some interest, especially if we get to the end of the period and we haven't paid, we have to accrue an interest expense. And then we need to look at the payment of the interest, especially when the accrual happens at a different time than the payment. And then finally, we need to book the payment or the repayment of the note at its maturities. So what we're going to do is we're going to walk you through an example here where we're going to go through each one of these steps. So let's get started here by looking at our example prompt. Assume that company A takes out $100,000 1-year note from the bank, which has a 5% interest rate attached. The note is taken out on October 1st, 20x1. Assume the year end is on December 31st, 20x1. Prepare all the transaction associated with a note. So just to walk you through what's happening here, we take out a note for $100,000. It is due in 1 year. We take this out on October 1st, 20x1, which means it's due on September 30th, 20x2, 1 year later. Now the books end on December 31st, which means that we're going to have to accrue the interest through the end of the year, book an interest expense and a payable, and then at the very end of next year, pay that interest and then pay the interest that we accrue in X2. So the reason why we're given a December 31st is we're going to close the book. So we need to put the expense associated for this note in the period in which it incurred. So there are some months that it was incurred in 20x1. So we're going to have to book an interest expense as an adjustment. We'll get to that in a second. Here we're doing step 1. Step 1 is the establishment of the note. So how do we establish the note? Well, what did we receive? We received $100,000 cash. And what did we give up? We gave up a promise to pay, a signature saying that we would pay back this $100,000. So since we received $100,000 in cash, cash is an asset, we will increase the cash account by debiting cash in the amount of $100,000. Okay? So debit cash for $100,000. Now, what do we credit? So we credit a liability because we owe. So we're going to credit the notes payable. And we're going to credit in the amount of $100,000. So now we've established the liability and we've also received the cash. So that's what the establishment of the note journal entry would look like. Let's go ahead and move on to the next part of the life cycle. So in the next part of the life cycle, we have to accrue the interest on the note. So we've borrowed this money for October, November, and December for 3 months, and we're going to need to accrue interest for those 3 months. The way that we can calculate the interest is using our interest calculation formula, which is the face value of the note multiplied by the annual rate, and most of the time, it is always stated to you in annual rate. If it isn't, it will tell you. So when I look at this and I see a 5%, that's not 5% per month, that's 5% per year. So assume all interest rates are per year unless otherwise stated in the problem. So and multiply by the annual rate. And then we're going to multiply that by the fraction of annual period. Since the rate is annual, we also need the time, which is the fraction of annual period, to be reflected as an annual rather than a month. So that by doing that, we'll get our interest. So let's kind of calculate this out. So we take out a $100,000 note, and the rate on this note is 5%. And the fraction of the period of a year. So how long have we had this note outstanding? Well, we've had it outstanding for October, November, and December. So that's 3 months. But we need to put it in a fraction of a year. So the fraction of the year would be 3 months out of 12 months. So we're going to fraction it 3 12s. Okay, so if you had 20 months, you could do 20 divided by 12. If it's 8 months, you could do 8 over 12. If it's a year, you could do 12 over 12. So again, fraction of a annual period. Okay, so 100,000 times 5% times 3/12 should give you $1,250. So that would be the interest that we have incurred during the period. So, October, November, and December. So it's cost us $1,250 to borrow the funds for those 3 months. So because it's an expense, we're going to debit interest expense. So debit interest expense in the amount of $1,250. And then we're going to credit not cash because we're not going to pay it. Now we're going to pay it at the end. So we are going to credit interest payable. So interest payable in the amount of $12.50. Okay, so that's what our journal entry would look like for the interest at the end of the year. Now let's move on to one more part of this life cycle. So now we get the payment of the interest. So the payment of the interest would happen when the note is due, because it doesn't say anything about paying anytime soon. So now we have to figure out how much interest have we incurred since we last calculated the interest expense. So we last calculated on December 31st, and now we're getting to the point where we are at the end of its life. So we're ready to pay the interest. We pay the interest on September 30th, 20x2. So we got to figure out how much interest did we incur between January 1st of 20x2 all the way to September 30th of 20x2. Well, if you do the math there, that's 9 months. So we're going to have to calculate interest for 9 months. So again, we can use our same equation here, $100,000 times 5% times 9/12. And if you do that math, you should get $3,750. So that's the amount of interest expense we incurred for the last 9 months. So now the question is, when we pay interest, how much are we paying? Well, we're going to pay this, obviously, but we also need to pay what we accrued at the end of last year. We accrued $12.50. So if we add that and this together, the amount of cash that's going to leave our pocketbooks is $5,000, or 5% of $100,000. So I'm going to credit cash here for $5,000, because that's how much cash I'm going to pay for interest. And then the question is, what's all of my debits? Notice I've got 2 lines I got to deal with. The first debit is going to be the release of the interest payable claim that we put in our books at the end of last year. So I'm going to debit interest payable in the amount of $1,250. So I'm getting rid of the payable. What's left? Well, what's left is the interest expense. So I'm going to debit interest expense. And the expense I'm going to book is the $3,750 that I incurred this year. One of the mistakes that students often make is they'll debit interest expense for $5,000, credit cash for $5,000, and then figure that there's just a blank space. The problem is you've already booked $12.50 of the expense last year, and so therefore we need to not book it here. We're booking the release of the payable. If you don't do the release of the payable here, your books are still going to show a payable of $12.50, even though you've paid for it on this date, really September 30th of 20x2. All right, so that's what the payment of the interest is going to look like when we get to the full year ending. Now, the only thing that's left is we're going to have to pay our note. So to pay our note, we are going to pay the $100,000 principal, and we're going to get released of that notes payable. So to do that, we are going to debit notes payable. So I'm going to abbreviate it with NP, and we're going to credit cash, because cash is going to leave our accounts. So cash, 100,000, notes payable, debit, releases it. So if we want to release our obligations, we do opposite of what we did when we first booked it, which was credit. So we're going to debit, and we're debiting because we are decreasing the liability. So debiting notes payable for 100,000, crediting cash for 100,000, and we have now completed the life cycle of a notes payable. So that is kind of understanding of notes payable, but then also showing you what the journal entries would be for the life cycle of that notes payable. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com, or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.